Hello and welcome back to another episode. Today we're going to talk about how you can fail when investing in gold and silver. Just as important as knowing what to do is knowing what not to do. Stay tuned. Before we begin, please like and subscribe to keep the channel going strong. Thank you. One of the primary concerns anyone has when putting their money into an investment is the thought they might not get it back. And while precious metals tend to be a reliable place to put your money, there are some mistakes people can make that might put them behind. So today we're covering common pitfalls so you can make smarter decisions about your gold and silver investments. Now, mistake number one is not understanding the difference between the products and how that affects current and future premiums. If you're new to metals, the premiums are the price over spot that you pay for the investment. It's what keeps mints and retailers alive. Now, some investment products, like ETFs, charge you a percentage fee each year, but a coin shop or bullion retailer can't do that. So the fee is collected up front. Now, generally speaking, the higher the premium, the greater the spread will be. And one of the issues that we run across in the gold IRA industry, for example, are phone shops that operate by nighttime TV ads and use call centers who take advantage of people who don't know what the premium should be and what products they should be invested in. They've been found to charge exorbitant premiums and push sales of commemorative and collectible coins. Now, you might come out ahead on collectible coins if you know what you're doing and how to buy and sell those. But in a gold IRA, you're limited to a specific process and people are paying premiums they can't get back. They're agreeing to buy esoteric coins in bulk with premiums of 50% or sometimes more. Now, for reference, a gold bullion coin like a Britannia or a Maple, it's easy to liquidate, can often be found with a premium of around 5%. So when you're thinking about investing, one of the mistakes that you can make is buying the wrong product. If you're new to investing and your goals are to store wealth and see a positive return on your investment, don't get fancy with the products, at least not at first. And if you need help identifying which coins or bars are preferred by seasoned investors, you can check out our Knowledge Center at learn.apmex.com where we've put together some helpful guides. Another mistake we see, especially in silver, is paying too much attention to the hype cycle. You've probably seen a few of these videos or articles out there saying things like, the world is running out of silver, or here's another one, the COMEX is running out of silver. You know, representatives from the COMEX recently said they're prepared and able to acquire 100 million ounces of silver on short notice. So there is supply available. There are price predictions on silver doubling, tripling, quadrupling. I've seen someone say silver would go to 100x, meaning over $2,200 per ounce, which is more than gold has ever been, by the way. I've seen price targets of silver at $100, $300, and even $1,000. These claims sometimes lead people to buy massive amounts of silver they can't afford in the belief they're going to get rich quick. And sometimes, and this is even worse, people are buying a lot of silver on credit and paying interest on it. This may sound kind of odd coming from a retailer who sells silver, but we don't want you making decisions that put you and your family in financial jeopardy. These stories about silver skyrocketing to the moon have been circulating for ages, though it goes through periods of, we'll say, extreme hype. It's still possible and common to secure your future and build real, tangible wealth with silver, but it's best not to invest in it with the assumption that it will make you rich in short order. Precious metals should reduce your risk, not increase it. And folks who jump in with both feet without understanding this sometimes end up buying high and selling low when they realize this isn't going to quadruple overnight. So a third common mistake is waiting for the prices to come back down only to realize later that they've missed an opportunity. The truth is that forecasting is incredibly difficult, often inaccurate, and we usually can't tell if prices are going down or reaching new highs until it happens. Forecasting is a very inaccurate science, and when we decide to wait for specific price targets, what we're doing is trying to time the market. Most financial advisors tell people not to do this because we tend to be very bad at it. Take a look at the data on gold prices from the year 2000 through 2010. Now, in the first couple of years of that decade, gold was dirt cheap. I mean, you could get an ounce for about $300 and often less. And then it started going up, first to $400, then broke past to $500, and it just kept going until it peaked in 2011, right around $1,800 per ounce. If you decided to wait for gold to drop back below $1,000 an ounce before buying, then you're still waiting over 12 years later because it has never gone down that low again. But if you could have bought an ounce of gold for $1,300 in 2018 or 2019, and that coin is now worth $1,950, you'd be pretty happy with a 50% return on your investment, I think. And for the folks all throughout the early 2000s who watched gold pass by so they wouldn't buy gold at $500, $600, $800 because it was too expensive, well, they might feel differently in hindsight knowing they could have had a return on their investment over 300%. Time in market beats time in the market. So the point is, if you believe in precious metals, don't try to time it or wait for the perfect opportunity. The perfect opportunity might be right now, and we just don't know it. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.